Hi, good afternoon, everyone. It's Terry Gardner from CJ Lawrence on Thursday, March 12th, with some market commentary in the midst of this fairly dramatic market downdraft. I've got 4 items I'd like to touch on today. First being to address our current operating assumptions. 2, I'd like to discuss what we're watching for from the Federal Reserve and other monetary agencies, as well as from the federal government. 3, I'd like to run through some recession math. And then 4th, discuss our investment strategy. So first off, with regard to assumptions, I don't think it's a stretch to assume that the headlines are going to be very negative for the foreseeable future. We're just starting to see the escalation of coronavirus cases across the country. Companies are pulling guidance. The economic impact of shuttered operations will start to filter into the market. So the news flow will be negative for some time. And I think on the back of that, we're likely to see a recession in the second quarter of this year and third quarter of this year. The fourth quarter still being a wild card. We'll have to get deeper into the year to sort through what the back end of 2020 looks like. And I think it's fair to assume that stocks are going to be headline driven for the foreseeable future as the market tries to price in the uncertainty, right? And as we know, when markets try to price in uncertainty, it oftentimes defaults to the lowest common denominator, the worst case or the bad case scenario. So we'll talk about that in a minute. Secondly, what we're watching for as in terms of a policy response to this, to the sell-off in stock prices, but also the challenges to the underlying economy. First off, we're watching to see where peak virus becomes in sight. So we're sliding up the escalation curve now, and at some point, the number of new cases will start to subside. Who knows where that is going to be, perhaps April, May, June, but that is something we're going to have to keep our eye on. That will tell us a lot in terms of what the recovery looks like. 2, monetary policy and response from monetary authorities. We've got a 50 basis point cut in the Fed funds target rate last week from the U.S. Fed. We've got a response from the New York Fed today, which is interjecting liquidity at the shorter end of the yield curve, which is very constructive because that helps grease the skids of the credit system and keeps the gears moving. And then third, we're looking for a federal government response. I think the response to the president's address to the nation last night was obviously viewed negatively in the market this morning. The Small Business Association has come out just a short while ago and announced that they were going to provide some relief to small businesses in the terms of loans. Those are the types of responses we are going to look for, and we think we'll see more of in the coming days that hopefully will provide some reassurance to investors and to business people. Third, I want to run through some recession math first for a second. I think it's constructive. I mean, the numbers are all over the map, and it's really hard to try to create a model when you have no idea what the economic outlook looks like for 2020. But perhaps it's instructive to look at past recession periods and to frame the discussion and provide some context. So I went back to look at the 08-09 credit crisis, which was dramatic in terms of its impact on the economy and the markets. And in 09 through 011, the PE multiple on the S&P 500 contracted dramatically from 19 all the way down to 13.5 at the bottom. It touched 13.5. It didn't stay there for very long. It actually rebounded back to 17 within a year. But if you just use that 13.5, that bottom basement multiple, and you apply that to recession earnings, so earnings that in 2021 wouldn't even eclipse what we achieved last year in 2019, that bad math equates to about a 10 to 12% target on the S&P 500, target below where we are today. If you apply the multiple that was achieved just within 9 months of hitting that 13.5 PE multiple and use 17 times that same earnings number, you get 10% upside from here. So down 10 to 12, up 10 to 12 feels like we're almost in the middle of the recession range. That is using kind of bargain basement earnings numbers below where we were even in 2019 for 2021, out 2 years. So just to we put that together just to give you a frame of reference for where we may be in kind of the earnings and PE cycle. And then finally, I'd like to highlight our investment strategy because I think it's important, particularly in these types of times, to know at CJ Lawrence, we're not buying the market, we're buying individual stocks. And this is the type of market where when the market sends all the babies out with the bathwater, there are opportunities to be very selective in specific names, not necessarily in the broader market. So, we continue to focus on the future, and with the confidence that as this all subsides, customers are going to return to buying iPhones. They're going to upgrade their Office 360 subscriptions. They're going to purchase new medical devices. Companies are going to increasingly adopt blockchain technology and artificial intelligence. Doctors will start to adopt novel gene therapies, and those are the trends that we're staying focused on. And these downdrafts often give us the opportunity to sharpen our pencil and really zero in on those opportunities and those powerful trends in the market. So that's where we are today. Feel free to give us a call if you've got any questions. 212-888-6403 is my number. Gardner at cjlawrence.com if you want to shoot me an email, and I'll get back to you ASAP. We'll be back to you with some more commentary in the next couple of days. Have a good day.